Good morning. My name is Gabe. I spent years in the trades, and now I track industry changes that actually matter to your service business. This is the Trades Brief. No bullshit, no fluff, no opinions here, just what changed and why you should care and how it's going to affect your business. 10 minutes or less, guaranteed. Today is Monday, January 12th, and here's the update. So bottom line up front, we're going to discuss a couple things. As we start the week, 4 things are becoming clear. Housing policy momentum is building. New construction is cooling in parts of the market. Labor costs are no longer flexible. And cash flow discipline is becoming the real separator for service-based businesses. So here's what changed and why it matters for this week. First, housing policy pressure is not going away. We talked about this last week, but it's developed even more. Between federal proposals aimed at limiting institutional ownership of single-family homes and state-level efforts to regulate corporate landlords, housing affordability is firmly back on the political agenda. Whether or not specific proposals pass, the signal is what really matters and how it affects your business. When policymakers focus on owner-occupied housing, it usually leads to longer homeownership cycles and more attention on existing housing stock. For service businesses, that environment generally favors maintenance, repair, and improvement work over the fast turnover work. So this is not a short-term spike. It's a structural direction worth planning around if you're in the service-based business. Second, builders are quietly adjusting to this. Price cuts, incentives, and slower sales are showing up in parts of the new construction market. So it doesn't mean housing is collapsing, but it does mean fewer people are moving and more people are staying put. This also goes to our point number 1 today. When homeowners stay longer, they invest in their home differently. They repair instead of replace. They upgrade instead of move. And they care about maintenance and more about efficiency, longevity, and operating costs. So that shift tends to benefit service businesses that are positioned for long-term relationships, not just a one-time move-in, move-out job. Third, labor costs are no longer a variable you can kind of wish away, if you ever could. Electrician wages continue to rise, and the same pressure exists across skilled trades. So this isn't a temporary spike. It's almost a complete reset. This is why Gen Z is now the generation toolbox. So for this week, that means being honest about staffing constraints, pricing assumptions, and capacity is important. If your pricing still assumes labor costs will stabilize or come back down, that gap will show up really fast in your margins. The businesses that adjust pricing and expectations early tend to absorb this better than the ones that delay. Fourth today, cash flow is becoming more important than revenue growth. Expanded access to small business funding is helpful, but doesn't solve bad cash flow management. So higher wages, higher material costs, and longer project timelines all put pressure on that working capital. So going into this week, the question isn't just how much work you have booked, it's how predictable your cash flow is, how quickly you can get paid, and how much flexibility you have if costs move again. So here's the signal to watch, taking all of that into account. Housing policy, building behavior, labor markets, and financing conditions are all pointing towards a slower, more deliberate environment in these industries. That doesn't mean less opportunity, though. It means the trades are becoming more professionalized and more disciplined, which I think is overall a really positive change in the industry. The businesses that win in this environment are the ones that plan, price clearly, and manage cash intentionally. So that's the update for today. If something changes, we'll always cover it here. This is the Trades Brief.